So the 4 layers, right? So the foundation is what I tell everybody is truly my day job, our day job, right? And that's just one of our services. It's not everything we do, but it is probably the majority, and it's something that we call a wealth maximization account. Now, there's other terms that are out there, but it's personalized banking. It's a more efficient way to grow your wealth, to protect and grow. Emergency savings, a very dear friend of ours who I think will do some videos with us in this series, says that this is an emergency and opportunity fund. And because I had it backwards that we talked about at the beginning, when I came in as a client and I said, I just want to fund my real estate more, in a more cool manner. I wasn't thinking of this whole foundational piece. I backed into that. I go a little bit further than what my friend Kim says when she says it's emergency and opportunity. I say it's emergency and then opportunity, right? So like solve the food, shelter, clothing of your finances first, and then move in. I know we're all excited about getting real estate, and we'll help you get there. But you got to have a foundation, because otherwise you're going to be the next, story out there that happened with many people, many investors in 2008 and 9. They lost everything. They were on the top of the world. They were making all kinds of money, and they lost everything because they had nothing to fall back on, right? When they fell off of that higher tier, they fell all the way to the bottom.
And I still know a lot of families that have not recovered, and that was over a decade ago, because they had a lot going on, lots of real estate, but the whole thing unwound and they had nothing to fall back on.
Yeah, and that's a great conversation. I hear that all the time from real estate investors and business owners, but they will say, I don't want to wait. I want to get my real estate, or I want to get my business because I need to stop work in 3 years or 4 years, right? That's a tall order no matter where you're starting from, and it causes people to take unnecessary risk. And so again, we should reframe what retirement looks like and not working looks like. Because I would say that a majority of Americans, this is kind of circling back, but I would say that a majority of Americans, when they say I want to retire, what they really mean is I don't want to do this job in this manner anymore. I don't want to get up and leave my kids and not be able to see soccer and fight in the congestion of traffic. That's really what we're trying to miss. So how do we solve that without putting this deadline on our lifestyle? I met with a young lady recently who was just retired from the military as a kind of a junior enlisted person who made it to 20 years. Just had kind of an average, decent career, but she hadn't saved anything, and she, way too late found out that the pension that she had for 20 years as a junior individual wouldn't pay her mortgage payment, right? And her big goal was, I don't want to work again. Like, I don't want another job. And it was tough, right? Because she served our nation, but didn't have the kind of financial guidance that helped her understand you need to reframe, but don't just quit and go cold turkey, because your family's going to suffer from that kind of an approach. So these different levels, right? So the bottom is, again, we tried to keep this simple. So the bottom is not about investing. The bottom is foundational. It's about savings and protection for the family. And then the tier above that is direct investing, and then indirect, and then speculative investing. And it's about really the relationship with your money. Right, that's the best way that I know how to explain it.
Yep.
Or your resources. Doesn't necessarily have to be money, but basically money. How connected and in close contact and control with my money am I? Right. So at the bottom, we can get really facetious about this and say, take everything you own, sell it, put it in a briefcase, stick it under your chair with a really good weapon. Right. Like that's pretty safe. Like whether you're going to lose that money or not, and what's happening to the money, well, you can look down and make sure you know. Right. So that's silly, but that's really, really safe, right? And on the other end of the pyramid,
and I would say it fits criteria for what we consider that foundation.
Yeah, right. It gets a little more exciting than that.
But again, it's one of those that
does it.
It does fit that.
Yeah, right. Exactly. So the foundational layer is about certainty, and I often talk to people about having like 2 tanks with water in them, and if you think of water as money, then when you get to this point where you don't want to be trading time for dollars or your efforts for dollars, well, then you can open these tanks, and the water kind of flows out and it funds lifestyle for you. It's called passive cash flow, right? And there's 2 different kinds of tanks. One is a risk tank, and the risk tank kind of like doesn't have a top on it, so sometimes the water evaporates in market corrections, right? But it can also grow faster, because a risk, like putting your money at risk, is investing, and so you can put it at risk over there in real estate and paper assets and things, or your business, and it might grow for you while you're sleeping, which is pretty awesome. And that will be like a renewable resource, and you can keep using it. But there's another tank, and it's called a safe tank. And we don't mix these 2 tanks. There's a product out there called universal life insurance. They try to mix these two products, and it does not work. And any of you that are old enough to remember the El Camino, that wasn't really a good car or truck, right? I mean, it might be collectible now, but no one bought them.
I've never heard that analogy before.
Right, so it's like
makes sense.
Like mixing them together is a mess. So back to kind of Patrick's point, a briefcase under your seat, and you have a good weapon to protect it. That's a safe asset. So is your savings account, thankfully today. I mean, 100 years ago it wasn't, but it is today. A safe in your house. Something buried secretly in the backyard, right? I mean, these are all examples of safe assets.
Yeah.
And you taught me 10 years ago that a whole life insurance policy is actually not just also a safe asset, but it's the one that the wealthy in America have used and globally have used along with real estate for long-term generational wealth.
But the idea is it's not just whole life. It's like there's ways you can design whole life, but the reason why we do it, right, is so that you have the highest degree of certainty, but the highest returns, right? The highest benefits.
Yeah.
Cash, I'm not saying cash is bad, because cash is, it's the most liquid form of money in a sense, but it's subject to inflation.
Yep.
It doesn't earn any interest. There's no additional benefits other than the fact that it's on paper and you can exchange it really easily.
Yeah.
Actually, there's some examples of not being able to change cash, where some people just take electronic payments. But my point is okay, cash is a way to do that, but is there a better way that has as high a degree of certainty but offers more benefits, tax benefits, earns interest, leverageability, and so forth?
Yeah, so I think maybe in the olden days before fractional reserve banking and fiat currencies and expanding money and all of that, maybe just having the foundational layer is possible. Somebody could work for their whole life and then their dependents could probably survive on that. But that's really, really risky. It's not even a fixed income anymore. It's just fixed asset. And that's pretty tough in today's world with inflation. So we never recommend to people that you just do the foundational wealth maximization account.
In pure cash.
In pure cash, right? So, but this gets you, just in a savings or checking account or the money under the seat, right? That's not a great plan in an inflationary world. And we've been, inflation's been happening for well over 100 years, so we're not going to, go get away from that anytime soon. So that's not a great plan. But when you get it growing efficiently with no taxes, that's a huge swing in the right direction.
And that's what we both. What we both discovered. Obviously, I taught you, but I discovered it because someone taught me. But there's a way in which you can design whole life so it meets that criteria. It's not just permanent life insurance coverage. There's some pretty awesome liquidity benefits, tax benefits, or interest benefits and loan benefits that come from it that we're wow, that meets that criteria, and it allows us to capitalize on other opportunities.
Yeah, and so that helps tremendously. So the maximum control or maximum security of your money, of your resources, and then maximum growth on it, still being safe and liquid, and then maximum access. So if you don't have access to the money or a majority of the money early, that's going to be a no-go for many people, certainly real estate investors. If I were telling you, hey, I have this great, amazing resource that I've used in my life, you should put it in place 5 years before you want to access it, right? That's not going to really be, we just don't have that horizon, and we don't need to have that horizon. So I put this in place, and I was probably Patrick's worst nightmare because it was hard getting the insurance in place.
Because you were active duty, an officer,
right.
Yeah.
Right, and so we had to get 4 policies, 2 on me, 2 on my wife. It took longer than expected, and my property was ready to go. And so we, 3 days after getting these policies in place, I had to borrow against them and get them going. So it's a little faster than we'd like to do, but certainly, within 30, 35 days, easy to access, 75% of the money, the way in which we design these. So. And more than 100% a few years down the road. So it's solid. So that's tier 1, really, right? And there's other things like protection, right? So what are we protecting? Well, anything is important, right? Anything is valuable, right?
I think our philosophy, and I'm not saying that this is the values that everyone should espouse. We've found that most people do, but there's a sense of stewardship that we have, right? Mm-hmm. As human beings. as entrepreneurs, as real estate investors. I mean, I know that there's probably some slumlord real estate investors, right, that will have property with horrible living conditions and just do it to exploit people. Like I get that, but I think most people that we do business with espouse our values, right? And so there's a big piece of the insurance component, which is a benefit of establishing a wealth maximization account where you have a built-in legacy, right? You have built in from day one, you are going to pass on a certain amount of money to the next generation, to a charitable cause, to whomever you appoint as a beneficiary. What that does, it's one of those, hopefully we do live, to life expectancy. We live to 95, 100. We have a friend that says that we're going to live to 150. I mean, based on medical innovation, I don't know. But there's no guarantee there, but there is a guarantee that, life is going to end at some point. And so what this does is it builds in a legacy. So it protects either business interests that you have, it protects family members, it protects charitable institutions or other institutions that rely on your expertise. Maybe you're on a board, maybe you just charitably contribute to them. Mm-hmm. But the idea is we have a sense of stewardship as far as creating financial independence, living a fulfilling life, but being responsible for those around us. And I think that gravitates into that whole self-actualization of Maslow, which is leaving a legacy. And that's why we refer to it not as like a benefit someone will get upon death. We look at it as a legacy benefit. This is money you're able to pass on. In addition to all the other benefits that apply to having tier 1 capital, being able to use it with investment, real estate, business. But this is another benefit that is locked in that will allow you to leave that legacy financially to whoever you appoint. And so
legacy, that's certainly a thing. Our ideas, our values, right, and paying those forward, but also allowing that to go on beyond us, right? It's projecting from the grave, I guess is a weird way to say it. But so there is a protecting legacy. We're also, helping our clients, and this isn't necessarily a day job for us. We don't do property and casualty insurance, but we're showing you where you might have blind spots. Are there other important assets in your world that you're not protecting? The number one thing that obviously life insurance protects, though, is us, is the breadwinner for the family. And there are those out there, other financial advisors that people have heard of, say that you don't need insurance when the kids are out of the home, right? And so here's the thing. I'm a car guy, so I'll go back to my analogies. So I want a 60s SC Cobra, right? That thing's like $250,000 nowadays. And I don't actually need it. So let's just assume I got there and I have my SC Cobra sitting in the garage. I have a 2013 Honda, which is really dependable, and it'll get me to work. I don't need the Cobra. So I'm just not going to insure it. No one's going to force me to if I paid cash for it. That just doesn't make any sense, right? If you value something, you should protect it, right? Same thing with your house. So if you value your spouse or yourself, why would you not protect that asset, right? And protect its value going way into the future, which again lives on beyond us. So yeah, we show, we help take a look and provide strategic partner help if you don't have disability insurance and you're a surgeon, obviously that's a silly example, but those things happen. And so we provide advice and we kind of help our clients there, but primarily we're helping protect that number one asset, the thing that's going to bring a ton more money into our lives than anything else will, regardless of whether you're W-2 to age 65 or not, it's going to bring the value.
100%.
So
I would say there's a few other protection components though. So insurance, the way in which we design it, it's still one of the only assets out there that's private. It's a private contract between you and a private institution. And there are built-in asset protection measures that are also important to understand. There are a lot of assets that can be seized by creditors. We live in a legal framework where it's innocent until proven guilty. But I've seen instances in which assets were frozen before there was a guilty and it ended up being not guilty. But it's one of those things where this is an asset, right, that is protected from those circumstances. And so that's another element of protection outside of the coverage of what we call human life value, which is obviously protecting you as the breadwinner, you as the earner, you as the like financial value.
Yeah, so privacy, having your money with a private company, your protection against creditors and confiscation and things like that. Yeah, great points, great points. This industry has 150 plus year record just in America, and it was created in Europe, a century before that. So an incredible track record.
So another, again, this goes to, you can kind of consider it protection, but as Gary mentioned, like this is a product that's been around for a really long time, and one of the innovations that occurred back in the early 1900s is, I mean, first off, this was where people saved until we had Wall Street and financial syndicated products, bonds, and mutual fund. Before that, this was the primary way in which people saved their money. However, there were business owners in the instance that innovated insurance. It was farmers that needed access to liquidity because they did not have consistent paychecks. Okay, they had harvest season, they had planting season, and then they had harvest season, right? So there's just 2 seasons, lots of expenses, lots of income. So they needed access to liquidity. So insurance companies innovated and created a private loan. So that's another, I would say, element of privacy is not only is it a private contract account between you and a private institution, they also issue you a private loan. Now, most loans, it's U4 filings, like it's public record, like bank loans and so forth. This doesn't show up on your credit report. It's a private loan, and it has variables, right? It has provisions of that loan that really you won't find in the typical banking institution. So again, that's another element of value as far as why we look at wealth maximization account as that ideal asset for tier 1.
Yeah, and certainly check out the loan course on all the details associated with that. And it's always fascinating to me how much different institutions will lend money on this asset, right? So the insurance company, it's kind of like, think about having a Rolex watch, right? And you go back to the Rolex dealer, he's going to immediately know the value of that asset. Right? He sells them all the time, right? So he knows the value. But if you go to a pawn dealer, maybe he knows. But if you go to the feed store dealer or feed store guy that you owe money to, he's not necessarily going to know how to sell it or how to value it. But if you go to a bank and ask, hey, I have $100,000 of cash in my policy, how much will you lend me on for that? Well, we have dozens that will lend you $100,000, 100% of the asset. Yet I've considered buying gold and storing it at a place where I could borrow against it. And that's about 65-70% is about as well as you can do. You all know that on the rental properties, if it's a first position loan, you can get maybe 75 or 80%. And it's hard to get a second position, right? So there's very few assets where somebody is willing to lend with no equity in the asset, and they'll do it all day long. Most commercial banks will do that, and so it just speaks to the strength of the asset. So certainly check out the loan asset one.